We're sitting here in late 2025, and I'm watching something that makes the dot-com bubble look like a kid's lemonade stand. The cryptocurrency market just hit $3.5 trillion in total value. Bitcoin is trading at over $100,000. Ethereum passed $5,000. And I'm getting the same sick feeling in my stomach I had in 1999, except this time it's worse, much worse. You see, I'm Warren Buffett. I'm 95 years old now, and I've lived through every major bubble in modern American history. The Nifty 50 in the early 70s, the dot-com mania, the housing crisis. And I'm telling you right now, what's happening in crypto isn't just a bubble. It's the biggest speculative mania in human history. And when it pops, and it will pop, the devastation will make 2008 look like a minor correction. Let me be crystal clear about something before we go any further. I don't say this lightly. I don't say this to get attention. I say this because I've studied markets for 70 years, and I know what mania looks like. More importantly, I know how it ends. And crypto, this whole digital asset craze, it's going to end badly for millions of people who are convinced they found a new paradigm. They haven't. They've found an old delusion with new technology. Here's what people don't understand about investing versus speculation. When you invest, you're buying something that produces value. When I buy a farm, it produces crops. When I buy a rental property, it produces rent. When I buy a share of Coca-Cola, I own a piece of a business that manufactures and sells products to billions of people, generating profits that flow back to shareholders as dividends. Now tell me, what does Bitcoin produce? What crops does Ethereum grow? What dividends does Dogecoin pay? The answer is nothing. Absolutely nothing. Bitcoin doesn't employ people. It doesn't manufacture products. It doesn't provide services that people need. It just sits there in a digital wallet, doing nothing, producing nothing, contributing nothing to the economy. Charlie Munger, God rest his soul, put it perfectly before he passed. He said, if you took all the Bitcoin in the world and offered it to me for $25, I wouldn't take it. What would I do with it? I'd have to sell it back to you somehow. It's not going to do anything. Charlie understood something most crypto enthusiasts refuse to acknowledge. An asset that produces nothing has no intrinsic value. But Warren, you might say, gold doesn't produce anything either, and you've acknowledged gold as having value. True. But gold has been recognized as valuable for 5,000 years across every civilization on Earth. It has industrial uses, it has cultural significance, and most importantly, I don't think gold is a good investment either. I've been consistent about that for decades. At least gold has the excuse of 5,000 years of history. Bitcoin has 16 years in a white paper written by someone who may not even exist. Let me give you some numbers that should make any rational person deeply uncomfortable. At the peak of the dot-com bubble in March of 2000, the total market capitalization of all internet companies was roughly $6.7 trillion. That was considered insane at the time. And most of those companies went to zero. Today, the crypto market is sitting at $3.5 trillion. But here's the thing that makes it even crazier. Those dot-com companies, as overvalued as they were, had revenue. Amazon was selling books. eBay was facilitating auctions. Even Pets.com, which became the poster child for bubble stupidity, was actually selling dog food. They had real customers buying real products. The business model was terrible. The valuation was absurd, but there was at least an attempt at commerce. Now look at the top cryptocurrencies. Bitcoin, the largest, has a market cap over $2 trillion. What's its revenue? Zero. What are its earnings? Zero. What does it produce? Zero. It's literally worth $2 trillion based purely on the belief that someone else will pay more for it tomorrow than you paid today. That's not investing. That's the definition of a greater fool theory. You're buying something worthless, hoping a greater fool will buy it from you at a higher price. Ethereum is valued at around $600 billion. Its use case, as the enthusiasts explain it, is to power decentralized applications and smart contracts. Sounds impressive until you realize that after more than a decade, there's still no widespread adoption of these applications. The only thing most people use crypto for is speculation, buying it and hoping it goes up so they can sell it to someone else. And then we have the truly absurd stuff. Dogecoin, a cryptocurrency that was literally created as a joke based on an internet meme, has a market cap over $50 billion. Let me repeat that. A joke currency is worth $50 billion. If that doesn't tell you we're in a bubble, nothing will. Here's how the crypto pitch usually goes. Someone tells you Bitcoin is the future of money. It's going to replace the dollar. It's digital gold. It's a hedge against inflation. It's decentralized, so governments can't control it. You should buy it before it's too late. So you buy some Bitcoin. The price goes up because more people are buying. You feel smart. You tell your friends. They buy. The price goes up more. Media coverage increases. More people buy. The price continues rising. Everyone who bought earlier feels like a genius. More people jump in, afraid of missing out. The price goes higher. But notice what's happening here. The only reason the price is going up is because more people are buying. There's no underlying business getting more profitable. There's no increase in productive capacity. There's no innovation creating value. It's pure speculation feeding on itself. As long as new money keeps flowing in, prices rise. The moment that flow stops or reverses, the whole thing collapses. This is exactly what happened with tulip bulbs in Holland in the 1,630 seconds. Tulip prices kept rising because people kept buying, convinced they'd found something special. At the peak, a single tulip bulb sold for more than a house. Then one day, people realized they were paying absurd prices for flower bulbs. The selling started, prices collapsed, fortunes evaporated. People who thought they were rich were suddenly bankrupt. The same thing happened with Beanie Babies in the 90s. People were buying stuffed animals for thousands of dollars, convinced they were investments. They weren't, they were toys. And when the mania ended, people were left holding worthless plush animals they'd paid rent money for. Crypto is the same dynamic, just with better marketing and more sophisticated technology. But the underlying psychology is identical. People buying something not because it has intrinsic value, but because they think someone else will pay more later. Everyone keeps comparing crypto to the dot-com bubble, but that comparison is actually too kind to crypto. At least the internet actually changed the world. E-commerce became real. Cloud computing became essential. Social media transformed communication. The technology was genuine and revolutionary. The problem was just that people paid ridiculous prices for it. Crypto has been around since 2009, 16 years. And what has it changed? You still can't buy groceries with Bitcoin. You still can't pay your mortgage with Ethereum. No major economy uses it as currency. The promise was that crypto would revolutionize finance, eliminate banks, democratize money. None of that has happened. What we have instead is a giant casino where people bet on digital tokens, hoping to get rich quick. The few legitimate use cases for blockchain technology, which is the underlying tech, don't require cryptocurrency at all. Banks can use distributed ledgers without Bitcoin. Supply chain companies can use blockchain for tracking without Ethereum. The technology has some utility. The coins are just speculative tokens piggybacking on that technology. And here's something that should concern everyone. During the dot-com bubble, most of the speculation was done by professional investors and wealthy individuals. Average families weren't mortgaging their homes to buy Pets.com stock. Today, I'm seeing regular people, young people, just starting their careers, putting their life savings into crypto. I'm seeing families going into debt to buy Bitcoin. I'm seeing retirement accounts being converted to crypto. When this bubble bursts, it won't just wipe out hedge funds and venture capitalists. It'll devastate middle-class families. Let me tell you about something most crypto investors don't understand. Tether. It's a so-called stable coin, meaning it's supposed to always be worth $1. The idea is that every Tether coin is backed by $1 held in reserve. Sounds reasonable, right? Here's the problem. Tether has issued about 140 billion of these coins. That means they should have $140 billion in reserves. Do they? Nobody really knows because they've never been properly audited.
They've released some murky attestations from accounting firms, but never a full independent audit. They claim they have the reserves, but they won't let anyone verify it. Why does this matter?
Because Tether is the oil that lubricates the entire crypto market. When people want to buy crypto, they often first buy Tether, then use that to purchase Bitcoin or other coins. Most crypto trading involves Tether. It's the foundation of crypto market liquidity. If Tether doesn't actually have the reserves they claim, if it's even partially backed by air, then a huge portion of the crypto market is built on fraud. And when that fraud is exposed, as all frauds eventually are, the entire market will collapse virtually overnight. It'll make the Lehman Brothers collapse look small by comparison. This is exactly the kind of structural risk that professionals understand but retail investors ignore. They see Bitcoin going up and think it's a sure thing. They have no idea about the rickety, potentially fraudulent infrastructure their speculation depends on. Right now, crypto operates in a regulatory gray zone. It's been allowed to grow largely unchecked because regulators have been slow to understand it and hesitant to act. But that's changing. Governments around the world are starting to wake up to the risks. The United States government is looking at much stricter crypto regulation. The SEC is cracking down on exchanges. The Treasury Department is concerned about money laundering and tax evasion. Other countries are going even further. China banned crypto entirely. India has implemented harsh restrictions. The European Union is rolling out comprehensive regulation. What happens when real regulation comes? When crypto exchanges have to follow the same rules as banks? When every transaction has to be reported to tax authorities? When know your customer and anti-money laundering rules are strictly enforced? The whole appeal of crypto for many users was avoiding regulation. When that's no longer possible, much of the demand will evaporate. And here's the uncomfortable truth. Crypto has attracted criminals precisely because it's unregulated. Drug dealers, ransomware operators, tax evaders, they all love crypto because it allows them to move money with less scrutiny than traditional banking. When regulation closes that loophole, a significant portion of crypto demand disappears because it was never legitimate to begin with. Let me talk about something the crypto enthusiasts really don't like discussing: the environmental cost. Bitcoin mining now consumes more electricity than entire countries. Argentina, the Netherlands. The entire Bitcoin network uses about 150 terawatt hours of electricity per year. That's roughly 0.5% of all global electricity consumption. For what? To maintain a speculative asset that produces nothing of value. The carbon footprint is enormous. Most Bitcoin mining is powered by fossil fuels because miners seek the cheapest electricity they can find. The amount of CO2 emissions from Bitcoin mining rivals that of major industrial nations. We're literally burning the planet to maintain a digital casino. Ethereum tried to address this with something called proof of stake, which uses less energy. But that doesn't change the fundamental problem. We're expending massive resources, environmental and economic, to maintain a system whose primary use is speculation. That's not innovation. That's waste on a planetary scale. What fascinates me most about the cryptomania is the psychology. The people who are most heavily invested in crypto don't just believe it's a good investment, they believe it's a revolution. They believe they're part of something historic. They've turned it into an identity. This is dangerous because once something becomes part of your identity, you can't evaluate it rationally anymore. If you're a Bitcoin believer, then evidence against Bitcoin becomes a personal attack. You can't process information objectively because you've tied your self-worth to the price of a digital token. I see young people on social media with laser eyes in their profile pictures signaling their commitment to Bitcoin. They've formed communities, created memes, built an entire culture around crypto. They're not investors making calculated decisions. They're true believers in a financial cult. And like all cults, questioning the doctrine is heresy. If you express skepticism about crypto, you're attacked as a boomer who doesn't understand technology. You're told you're going to miss out. You're told you just don't get it. The hostility to any questioning is a classic sign of a bubble. When people can't tolerate criticism of their investment, it's because deep down they're afraid the criticism might be valid. Charlie Munger used to talk about psychology in investing more than any other factor. He'd say that most investment disasters aren't caused by bad analysis of the facts. They're caused by psychological factors. Emotions overriding reason, social proof, authority bias, commitment bias. Crypto hits every single one of these psychological vulnerabilities. So what happens when the crypto bubble finally bursts? Because it will burst. Every bubble in history has burst. This one will too. I don't know what will trigger it. Maybe a major exchange collapses. Maybe Tether is exposed as a fraud. Maybe governments crack down harder than expected. Maybe people simply wake up one day and realize they're holding worthless digital tokens. But when it happens, the collapse will be swift and brutal. Crypto markets have no circuit breakers, no trading halts, no protections for retail investors. When the selling starts, it'll be panic. Bitcoin could lose 80 or 90% of its value in weeks or months. Smaller cryptocurrencies will go to zero. People who thought they were millionaires will find out their wealth was always an illusion. The human cost will be enormous. Families will lose their savings. Young people will see their financial futures destroyed. The psychological impact of losing everything in a speculative mania is devastating. Depression, divorce, even suicide rates typically spike after major financial collapses. This won't just be a market correction. It'll be a personal tragedy for millions of people. And here's what really bothers me. The people promoting crypto the hardest, the exchanges, the influencers, the crypto billionaires, they'll be fine. They've already taken profits. They've diversified into real assets. They've sold their digital tokens to retail investors at the top. When the collapse comes, they'll walk away wealthy while the people who believe their hype lose everything. This is exactly what happened in every previous bubble. The insiders get rich. The retail investors get destroyed. And somehow, people never learn this lesson. Look, I understand why people are attracted to crypto. They see the price going up and they want to participate. They feel like they're missing out. They want to get rich. I get it. But there's a difference between wanting to get rich and being willing to do it intelligently. Real investing means buying assets that produce value, a business that makes products people want, a property that generates rental income, a bond that pays interest. These aren't exciting. They won't make you a millionaire overnight, but they work over time, consistently. They build real wealth. Berkshire Hathaway has been in business for over 60 years. We've never bought a cryptocurrency. We never will. And we've generated returns that have made our shareholders wealthy, not through speculation, not through gambling, but through careful analysis and patient investing in productive assets. When I buy a stock, I'm buying a piece of a business. I can analyze that business. I can look at its revenue, its profit margins, its competitive position, its management. I can make a rational estimate of what it's worth. And if the stock price is below that intrinsic value, I buy. If it's above, I don't. It's not complicated, but it requires discipline. With crypto, there's no analysis you can do. There's no intrinsic value to calculate. There's no way to determine if Bitcoin at $100,000 is cheap or expensive because there's no rational basis for any price. It's pure speculation. You're just guessing. And guessing is not a path to sustainable wealth. Here's what I've learned in 70 years of investing. Human nature doesn't change. Every generation thinks they found something new. Every generation thinks this time is different. Every generation believes they're smarter than the last one. And every generation learns the hard way that the fundamental principles of value and price, of risk and return, of sanity and speculation, these things never change. In the 20s, people thought they'd discovered perpetual prosperity. Stocks would only go up. Then came 1,929. In the 60s and 70s, people thought the Nifty 50 stocks could never go down. They were wrong. In the late 90s, people thought internet stocks had created a new paradigm. The crash of 2000 taught them otherwise. In the mid-2000s, people thought housing prices could only rise 2008. proved that wrong too. Now it's crypto. Same pattern, different asset. The belief that somehow this time the old rules don't apply. The conviction that anyone who doesn't see it is just old and out of touch. The certainty that you're going to get rich if you just hold on. It never works out that way. It never has. It never will. So where does this leave us? I'm not invested in crypto. Berkshire isn't invested in crypto. We have no plans to invest in crypto, ever. I don't care if Bitcoin goes to $1 million. I don't care if I look like a fool for missing it, because I understand something that most crypto investors don't. Making money by selling something worthless to a greater fool isn't investing. It's gambling. And I didn't build a $700 billion company by gambling. Right now, Berkshire's sitting on over $300 billion in cash and short-term securities. People criticize me for this constantly. They say I'm missing opportunities. They say I'm too old and too cautious. They say I don't understand the new economy. I've heard it all before. I heard the exact same things in 1999. Then the market crashed and suddenly I wasn't a dinosaur anymore. I was a genius, but I didn't change, the market did. I sleep well at night knowing that Berkshire's capital is safe. When the crypto bubble bursts, when the speculation ends, when reality reasserts itself, we'll still be here. We'll still have our capital. We'll still be able to invest in real businesses at reasonable prices. And the people who are calling me a fool today will wish they had listened. If you're young and you put money into crypto, I'm not here to judge you. I made plenty of mistakes when I was young. But I want you to think carefully about what you're doing. Ask yourself some hard questions. Do you understand what you own? Can you explain why Bitcoin has value beyond someone else being willing to pay more for it? Do you know how blockchain actually works? Have you read the white papers? Do you understand the risks? Can you afford to lose this money? If Bitcoin went to zero tomorrow, would you be okay, or would it devastate you financially? If it's the latter, you're gambling with money you can't afford to lose. That's not investing. That's desperation. Why are you invested in crypto? Is it because you've done careful analysis and concluded it's undervalued? Or is it because you're afraid of missing out because everyone else is doing it, because you want to get rich quick? Be honest with yourself about your motivations. If you can't answer these questions confidently, you should seriously consider getting out. Yes, you might miss further gains if the bubble continues, but you'll also avoid the catastrophic losses when it pops. And trust me, losing 50 or 80% of your money will hurt a lot more than missing out on gains ever could. Let me end with this certainty. The crypto bubble will burst. I don't know when. Nobody does. It could be next month. It could be next year. It could take several more years. Bubbles can persist longer than rational people think possible, but it will end. They always do. When it does, people will look back at 2024 and 2025 the same way we look back at 1999 and 2000. They'll shake their heads in disbelief at the prices people paid for digital tokens. They'll wonder how anyone could have thought this made sense. They'll write books and make documentaries about the madness, and the investors who preserved their capital, who stayed patient, who refused to get caught up in the mania, they'll be the ones positioned to profit from the real opportunities that emerge from the wreckage. That's where I plan to be. And if you're smart, that's where you'll be too. 25 years ago, people called me a dinosaur for not investing in internet stocks. Then the NASDAQ lost 78% of its value and Berkshire stock doubled. Today, I'm the old man who doesn't understand crypto, the skeptic who's missing the opportunity of a lifetime, the cautious investor being left behind. That's fine. I've been called worse. But in a few years, when we look back at the crypto mania of the mid-20s, we'll see it for what it really is. Not a revolution, a bubble, the biggest bubble in human history. And everyone who saw it for what it was and stayed away will be very, very glad they did.